Hi guys, welcome to my channel. My name is Chandrakant. I am pursuing MBA in Sri Venkateswara Engineering College, Bangalore. Let's move on to the video. My subject is financial management and my topic is sources of working capital. Let's move on to the topic. Sources of working capital. Working capital is the lifeblood of any business. It's the main money a company needs to operate on a day-to-day basis. Understand the sources of working capital is crucial for businesses to maintain financial stability and grow. In every business activity, wants to operate the business needs to financially more money is required for purchase of raw materials and other things will require more money. Definition of working capital. Working capital is the difference between a company's current assets and current liabilities. Current assets are those that can be converted into cash within a year, while current liabilities are those that must be paid within a year. This matrix is virtual for business success. Current assets are cash, accounts receivable, inventory, and prepaid index expenses. Current liabilities are accounts payable, short-term loans, and accrued expenses. Working capital is difference between company's current assets and current liability. It will balance at the end of the financial year. Importance of adequate working capital. Adequate working capital ensures smooth operations and meets short-term financial obligations. It provides flexibility to adapt to unexpected challenges, invest in growth opportunities, and maintain financial health. In adequate working capital, it requires smooth operations and maintain financial health in the every business activity. Maintaining short-term obligation, paying for salaries, rent, and utilities and other expenses on time. In sources of adequate working capital wants to pay rent and other utilities to uh, uh, and pay salaries for the employees in the organization. Managing inventory, Purch- purchasing and stocking inventory to meet customer demand while advising excess inventory. Investment opportunity, funding new product development, marketing companies or expansion projects. In the working capital required to expand another business in the same company and required to purchase new product for executing the operations in the company. Internal sources of working capital. Internal sources of working capital comes from the business itself, generating though its operations. Profitable operations. Gathering revenue and controlling costs. It requires more revenue from the public and controlling the cost in the production. Inventory management. Optimizing inventory levels to reduce holdings cost. Inventory means raw materials will be optimized level and reduce the holding costs. Accelerating collections. Collecting receivable promptly. External sources of working capital. External sources of come from outside the business, typically from lenders or investors. Short-term loans. Loans with maturity of less than a year. In short-term loans, we take the loans for less than a year. Lines of credit. Flexible credit arrangements allowing businesses to borrow up to a predetermined limit. In these lines of credit, organization will take or borrow a loan from financial institution. There is no predetermined limit. Factoring, selling accounts receivable to a factoring company for immediate cash. In the uh, external sources of working capital, when we require money for the organization, some activities, selling accounts to factoring company for immediate cash, they require money for any amount of cash for salary or other things. We require cash, that it will be sold by organization. Equity financing. Equity financing involves raising funds by selling ownership shares in a company. This can dilute existing shareholders' ownership, but provides long-term capital without depth. In equity financing, required owners will sell their shares in a company, because equity, when we required for cash in the organization, they sell the whole shares to the public. Venture capital. Investment by venture capitalist is high growth companies with potential for significant returns. In venture capital investment by venture capitalist, there is high growth in the companies while investing the money in their own companies. Private equity. Investment by private equities firms in established companies seeking to improve operations or extend. Debt financing. Debt financing involves borrowing money from leaders which must be repaid with interest. This provides immediate funds but creates a financial obligation. Bank loans. Traditional loans from banks with specific terms and interest rates. In banks, we require loan for specific amount of interest rates, and specific terms will be included in rules and regulations when we require to rework the funds. Bonds. Debt securities sold to investors offering a fixed rate of returns. Commercial papers. Short-term unsecured debt issued by operations to raise funds. In commercial papers, they include the certain rules and regulations for uncertain debts issued by corporations to raise funds to the organization. Managing working capital efficiency. Effective working capital management ensures sufficient funds to operate while minimizing unnecessary investment. Optimize inventory. Minimize excess inventory and ensure timely delivery. Manage receivable. Collect payments promptly and reduce bad debts. Control payables. Navigate for favorable payments terms and avoid unnecessary delight. Thank you for watching. Please like, share and subscribe to my channel.